Now, one of the biggest movers in the Asia Pac today is CSL. That's the Australian blood plasma product maker, and it's raising shares. But also in the U.S., the parade of companies raising capital on Wall Street is also continuing. That includes Steel Dynamics and also TK Tankers. They are joining more than 150 other companies who have already sold shares or issued debt. But the capital raising is also threatening to dilute corporate profits. And Michelle McQuarrie looked at how big of a threat this is, and she joins us from our New York studios. Michelle?
Hi there, Susan. Well, here at Bloomberg, we have crunched the data, and we found that the combination of selling shares and cutting dividends will reduce equity returns as much as 4.1% annually. More than 150 companies have raised $82 billion this quarter. Now, that is higher than the record we saw during the technology bubble of 2000. That means after a period of a lot of M&A and buybacks, which reduced the number of shares outstanding on the S&P 500, that'll go up by 3.4% on an annualized basis. So already weak earnings are going to be spread across a larger pool of stock, which could mean earnings may not come in as high as expected. Now, based on Bloomberg's analysis, that will cut per-share earnings by 3.3%. Susan?
And Michelle, with more and more companies doing this raising capital, doesn't this hurt shareholders?
Well, it does. And the question is, why are companies doing this? Well, really, because they can. Investor appetite has improved for equities, and some of these companies are being told, get in now while you can, because we just don't know what lies ahead in these tumultuous times. Investors seem to be biting and buying. Now, also, if some of these companies don't have capital, well, they'll go out of business. So the rationale is better to get that smaller slice of something than nothing at all. So they're not only raising capital, but they're also cutting dividends. And combined payouts are expected to fall 21% this year. That's the most since 1938. And overall, that will reduce the return on the S&P 500 by 4%. Now, speaking of the S&P, many expect that the rally there will come to a halt, saying that we peaked in May. According to Barini Associates, we will be seeing a slowdown. And Barini uses a technique called money flow analysis, and money flow tracks the size and direction of every trade on the assumption that trades at prices lower than the prior transactions are sales, while trades done higher are buys. Now, aggregated, the data shows whether money is going into or coming out of a stock or index. So when set to zero at the start of this year, money flow for the S&P was $2.79 million on March 9th. That is when the index sank to a 12-year low. It surged to $63 billion on May 14th and has since dropped to $52 billion. And Susan, the question is, well, will it drop further or will it rise further? According to Barini Associates, expect a drop. Susan?
Ooh. Okay, Michelle, thank you for that. Michelle McQuarrie in New York.